The stock market just had its worst week since 2022. But the real question is not what happened last week. It is what happens in the next 3 weeks, and 3 specific dates are going to determine everything. 5 consecutive weekly losses. The Dow, NASDAQ, and S&P 500 all in correction territory or approaching it. Oil above $110. Consumer confidence at its lowest in over a year. If you are watching this on the weekend wondering what to do with your money, this video is for you. Because the next 3 weeks are not going to be random. There are 3 dates on the calendar that will drive every significant market move between now and mid-April. And if you understand what each one means before it arrives, you will be ahead of most investors. Those 3 dates are April 3rd, the U.S. non-farm payrolls report; April 6th, Trump's extended deadline for Iran to negotiate; and mid-April, when a critical oil supply estimate says the global shortage could double. In this video, I am going to tell you exactly what each date means, what outcome moves markets in which direction, and how to position yourself intelligently before these events hit. April 3, the jobs report that could change everything. April 3rd is Good Friday, which means U.S. markets are closed, but the non-farm payrolls report, the monthly jobs data, still gets released at its scheduled time. And this particular report may be one of the most important of the year. Here is why it matters so much right now. The Federal Reserve is caught in a trap. On one side, inflation is running above its 2% target, partly because of oil. That tells the Fed to hold rates steady or even raise them. On the other side, hiring has been described by Fed Chair Powell himself as anemic. Job creation is at essentially zero. If the economy starts shedding jobs, the Fed needs to cut to support growth. These 2 forces are pulling in opposite directions, and April 3rd's jobs report is the data point that tips the scales. If April 3rd shows strong jobs, say above 150,000 new positions, it gives the Fed breathing room. Inflation is the bigger problem. The economy can handle higher rates for longer. Markets stabilize as recession fears ease. If April 3rd shows weak jobs, below 100,000, or worse, a negative print, the stagflation case becomes undeniable. The Fed is genuinely stuck. It cannot cut because inflation is too high. It cannot hike because unemployment is rising. Markets fall as that reality sinks in. The University of Michigan Consumer Sentiment Survey released Friday is already a warning signal. It fell to 53.3, down nearly 6% from February. Inflation expectations among consumers rose to 3.8%. When consumers are worried and scaling back spending, jobs follow. April 3rd will tell us whether that concern has reached the labor market yet. One more critical detail. U.S. markets are closed on Good Friday. That means any market reaction to the payrolls data happens Sunday night in futures trading and does not fully land until Monday, April 6th, which is also Trump's Iran deadline day. 2 major catalysts colliding on the same Monday could produce extreme volatility in either direction. April 6th, the Iran deadline and what happens next. April 6th is Trump's extended deadline for Iran to reach a meaningful framework on reopening the Strait of Hormuz. Let me give you the honest picture of where things stand right now, because it is more nuanced than the headlines suggest. On one hand, there are some genuine signals of partial movement. Trump said this week that Iran allowed 10 oil tankers to pass through the strait as a, in his words, present to the United States. Iran is conducting selective passage for neutral nations. Pakistan is reportedly hosting back-channel talks between U.S. and Iranian officials. These are not nothing. On the other hand, geopolitical strategist Marco Papich at BCA Research has published one of the most alarming estimates of the week. He calculates the world has currently lost 4.5 to 5 million barrels per day of oil supply from the war. But he warns that number will double by mid-April, making this the largest loss of crude supply in history. The reason, as the conflict enters its second month, the secondary effects, Supply chain disruptions, shipping rerouting, refinery shutdowns compound on top of the direct Hormuz blockage. That mid-April supply doubling is the number that overhangs every market conversation right now. It is the reason Goldman Sachs maintains its worst-case Brent target of $147 per barrel if the conflict persists. So what are the possible April 6th outcomes? Scenario 1. A credible ceasefire framework is announced, even temporary, even partial. Oil falls sharply, potentially back toward $90. Markets rally hard. The S&P 500 could recover 3 to 4% in a single session. This is the relief rally scenario. Scenario 2, talks collapse or stall. Trump follows through on threats against Iran's energy infrastructure. Iran retaliates across the Gulf. Oil spikes toward $120 to $130. Markets fall sharply. This is the escalation scenario. Scenario 3, and this is the one most likely to frustrate investors, more ambiguity. Another deadline extended. More talk of talks. Oil stays range-bound at 105 to 115. Markets continue their grinding, headline-driven volatility. This is the exhaustion scenario. Right now, markets appear to be pricing scenario 3. That is why every rally is sold within 48 hours. Investors do not trust the positive signals anymore after 3 false dawns this month. Mid-April, the supply cliff and what it means for investors. The third date is less precise, but arguably the most important for the medium-term economic picture. Mid-April is when BCA Research estimates the oil supply loss will double from the current 4.5 to 5 million barrels per day to approximately 9 to 10 million barrels per day. To put that in context, the 1973 OPEC embargo, the most severe oil shock of the 20th century, removed approximately 5 million barrels per day from global supply. If BCA's estimate is correct, we will have surpassed the 1973 shock by mid-April. What does that level of disruption actually mean for consumers and investors? First, petrol prices continue rising. U.S. gas prices have already risen for 23 consecutive days, reaching $3.96, up 34% in a single month. That is a bigger one-month gain than after Hurricane Katrina or the Russian invasion of Ukraine. If supply halves again, that number pushes toward $5 a gallon in the U.S. and past £2 a liter across most of the U.K. Second, food prices start moving. Oil underpins the entire food supply chain: fertilizer production, transportation, refrigeration. At sustained oil above $110, food inflation follows with a 4 to 8 week lag. Analysts are already warning of grocery price hikes in coming weeks. Third, corporate earnings estimates start getting cut. S&P 500 companies are currently priced for 17% earnings growth in 2026. That estimate was built on oil at $60 to $70. At sustained 110 plus, energy costs hit every sector's margins. Watch for earnings guidance downgrades starting in Q1 reporting season in April. But here is the counterbalance that investors need to hold alongside this concern. Energy companies, oil majors, refiners, pipeline operators are having their best quarter in years. Every dollar of higher oil prices is a dollar of higher revenue for them. If you hold an energy ETF like XLE or individual oil majors, you are one of the few investors whose portfolio has been going in the right direction this entire month. And here is the longer-term truth about oil shocks. They are self-correcting. At $147, the 2008 record, demand destruction kicked in within weeks. Consumers stopped driving. Airlines cut routes, industrial production slowed, and oil fell back as fast as it had risen. The economic pain is real, but oil at extreme levels carries the seeds of its own correction. The most important thing for investors to understand right now: this is a supply shock, not a financial crisis. The banking system is sound. Corporate balance sheets are generally healthy. The economic damage is concentrated and specific. Painful, yes. Permanent, no. 3 dates, 3 decisions. April 3rd, the U.S. jobs report. Strong jobs. markets stabilize. Weak jobs, stagflation confirmed, markets fall. Released on Good Friday, fully priced by Monday, the same day as the Iran deadline. April 6th, Trump's Iran deadline. A ceasefire framework. Oil falls to 90, markets rally hard. Escalation, oil spikes toward 120 to 130, markets fall sharply. More ambiguity, grinding volatility continues. Mid-April, the oil supply cliff. BCA Research estimates the global supply loss doubles from 5 to 10 million barrels per day, potentially surpassing every historical oil shock on record. If that materializes without a Hormuz resolution, the economic damage enters genuinely uncharted territory. Watch those 3 dates. Understand what each outcome means before it happens. And remember, every major oil shock in history has eventually resolved. The question for investors is not whether markets recover. It is whether you are positioned to benefit when they do. If this week ahead breakdown helped you understand what is coming and why, please give this video a like and subscribe to Global Finance Market News. We cover the stories that move your money every single day. Hit the notification bell. The next 3 weeks could define the rest of 2026 for investors. Everything in this video is for educational and informational purposes only. This is not financial advice, and I am not a financial advisor. Please always do your own research before making any investment decisions. Past performance is never a guarantee of future results. Always consult a qualified financial professional before investing.